Hey, I've heard about index funds, but what exactly are they? Like, is it some kind of boring savings account or what?
Nah, it's way cooler than that. Think of an index fund like a big basket that holds a bunch of different stocks, all picked to match a famous list of companies, like the S&P 500. That's this group of the top 500 big U.S. companies, from tech giants to everyday brands. Instead of you or some hotshot manager trying to guess which single stock will skyrocket, the fund just copies the whole list. So if the overall market goes up, your basket goes up too. It's passive, meaning it doesn't chase trends or make fancy moves. It just mirrors the market's natural flow.
Okay, that sounds simple, but why would anyone want something so basic? Wouldn't it be more fun to pick exciting stocks, like betting on the next big video game company?
I get that. Picking winners feels like a game, right? When I was your age, I thought investing was all about spotting the next Apple before anyone else. But here's the thing. Most people, even pros, aren't great at picking just the right stocks. Studies show over 80% of active funds, those where managers try to beat the market, actually underperform simple index funds over 10 years. Why? Because picking winners is tough. Markets are unpredictable, and fees eat into gains when you're trading a lot. Index funds keep it straightforward. You own a slice of everything growing in the economy, like spreading your snacks at a party so you don't miss out if one runs low. Boring? Maybe, but reliable, like a steady bike ride instead of a wild roller coaster that might crash.
So it's not gambling on one horse, but riding the whole herd. That makes sense for not losing big on a bad pick, but how does just copying the market actually make money? Doesn't the crowd sometimes get it wrong?
Exactly, you're getting it. The crowd isn't perfect. Markets dip when people panic, like during that 2008 crash when everyone freaked about houses. But over time, the overall economy grows because companies innovate, people buy stuff, and wealth spreads. Index funds ride that wave. For example, if you put $1,000 in an S&P 500 index fund back in 1990, it'd be worth over $20,000 today, even with all the ups and downs. That's because historically the market averages about 7 to 10% growth a year after inflation. You're not betting on the crowd being smart every day. You're betting on the long-term engine of business and progress. It's like planting a tree. You don't watch it grow hour by hour, but decades later, it's shading your yard.
Whoa, that tree thing helps. So my money just grows with the whole economy? No need to stress over daily news?
Yep, that's the beauty. No staring at stock tickers, worrying if one company's scandal tanks your savings. With an index fund, a scandal might ding one stock, but the other 499 balance it out. Diversification. That's the word for spreading risk, is built right in. It's why folks like Warren Buffett, this investing legend, recommend index funds for most people. He even bet $1 million that an S&P 500 index fund would beat a group of hedge funds over 10 years. And he won. Big time. Simple beats fancy most days.
Buffett? Cool, I didn't know that. Alright, so index funds are like a chill way to join the market party without picking the playlist. But if it's all automatic, how does it actually follow the market without someone making choices every day?
Great question. That gets into the nuts and bolts of how these funds stay on track. So let's break it down. An index fund tracks a market index, like the S&P 500, by basically making an exact copy of what's inside it. The S&P 500 is this snapshot of 500 huge U.S. companies, weighted by how big they are, like Apple or Microsoft, taking up more space because they're massive. The fund managers don't pick and choose, they just buy shares in those same companies, in the same proportions. If Apple makes up 7% of the index, the fund puts 7% of its money into Apple stock. It's like photocopying a recipe instead of inventing your own. Everything matches.
Okay, so they buy the whole list, not just favorites. But what if one company changes size or gets kicked out? Does someone have to watch that all day?
Smart catch. Yeah, the index itself gets updated a few times a year by a committee that decides if a company still belongs. Like if it's grown too small or gone bankrupt, they swap it out. The fund automatically adjusts too through rebalancing. That's when they sell a bit of what's overweighted and buy more of what's under to keep matching the index perfectly. It's all done with computer algorithms now. Super efficient. Like a robot barista remixing your coffee order to match the menu. No human sitting there guessing. It's rule-based and happens quarterly or when big changes hit. This keeps costs down because there's barely any buying and selling. Just tweaks to stay true.
Rebalancing sounds like housekeeping. So my money buys a tiny piece of all those companies. If the index goes up 10%, does my fund go up about the same?
Exactly right. Your investment gets you a proportional slice. Say you put in $100. That's like owning a speck of each of those 500 stocks. And yeah, the fund aims to mirror the index's performance minus a tiny fee. If the S&P 500 rises 10% in a year, your fund should too, give or take a fraction. It's not perfect. There might be a slight lag from trading costs or cash holdings, but it's close enough that over time, it nails the market's moves. Remember that 1990s boom? Tech stocks exploded and index funds rode that wave without managers scrambling to catch up.
Got it. Like being in a boat that follows the river's current instead of paddling against it. But isn't following the crowd kind of risky if everyone's wrong together, like in a bubble?
Bubbles happen. Sure, like the dot-com craze in 2000 when everyone piled into internet stocks and then poof, it burst. The whole S&P dropped 50%. But tracking the index isn't blindly following the crowd's worst moods. It's tying your boat to the entire river, which includes solid banks and steady flow from real economic growth. The key is the long view. After that burst, the market climbed back higher than before, hitting new records by 2007. Index funds capture that recovery because they hold everything, not just the hype stuff. It's diversified, so one sector's flop gets cushioned by others chugging along, like how groceries keep selling even if gadgets tank.
Diversified. Yeah, that word again. So no single mistake wipes you out. Makes me think of my grandma's quilt. All patches, no one big hole.
Love that analogy. Your grandma's got it right. Index funds are like that quilt, sewn from the market's fabric, strong because it's widespread. And the tracking, it's passive, so no ego-driven trades that could flop. Funds like Vanguard's S&P 500 ETF do this for millions, holding trillions in assets, all synced up automatically. You can even buy into it through a regular brokerage app, starting with pocket change.
Trillions? Wow. So it's battle tested. All right, if it's this hands-off and mirrors the pros list, why do people still shell out for those active funds where experts try to outsmart it?
That's the million-dollar puzzle, and it boils down to what you're really paying for when you invest.
Paying for what? Like fees or something? I mean, if index funds are so easy, do they cost less to own?
Spot on. You nailed it. Fees are a huge part of why index funds shine. See, when you buy into a fund, there's this expense ratio, kind of like a service charge for running the show. For active funds, where experts are constantly researching stocks, meeting companies, and swapping picks to try beating the market, those fees can bite, often 1% or more of your money each year. That's like paying $10 a year on every $1,000 you invest just for their efforts. But index funds, they're dirt cheap, usually 0.05% to 0.2%. So on that same $1,000, you're out maybe 50 cents a year. Why the difference? No fancy stock picking circus.
50 cents? That's like lunch money. But shouldn't the experts charge more if they're supposed to make you richer by outsmarting everyone?
You'd think so, right? It's like hiring a chef to whip up a gourmet meal versus grabbing a sandwich from the corner store. The chef costs a fortune because of all the ingredients, testing recipes, and tweaks. Active managers do the same. They hire teams of analysts to pore over financial reports, predict trends, and trade stocks often, sometimes daily. That research and all those buys and sells rack up costs, from salaries to transaction fees. Plus, they got to market themselves as the next big thing to attract investors. But here's the kicker. Most don't beat the market after those fees. It's like the chef's meal tastes great, but costs so much you can't afford seconds, while the sandwich keeps you full without breaking the bank.
So, index funds skip the chef drama. No analyst guessing which stock's hot. That saves a ton.
Exactly. Index funds are passive players. No need for a squad of experts debating if Tesla's going to zoom or zoom out. They just follow the index recipe. Buy the listed stocks, hold them, and rebalance occasionally with computers doing the math. Minimal trading means tiny commission costs. No constant churning that active funds do, which can turn into a fee-eating machine. And broad diversification? That's baked in. You're not chasing one hot sector. You're holding the whole market. So no big research bets on winners or losers. Companies like Vanguard or Fidelity run these behemoths with economies of scale. Billions poured in means costs spread thin, like buying pizza for a party of two versus a classroom. Lower fees mean more of your money stays working for you, compounding over time.
Compounding again? Okay, so if I'm not paying for all that extra hustle, my return should be closer to the real market gains. But what about taxes? Doesn't trading less help there too?
You bet. Great point. Active funds trade a lot, triggering taxes on gains each year, which nibbles at your pot. Index funds sit tight, so you only pay taxes when you sell, letting gains grow tax-deferred longer. It's like letting your savings jar fill up without dipping in for management snacks. Take my buddy who started investing in college. He picked an active fund chasing tech booms, paid 1.2% fees, and watched a chunk vanish yearly. Switched to an index fund at 0.04%, and over 15 years, that fee savings added thousands he wouldn't have seen. Fees aren't sexy, but they're silent thieves, or saviors, depending on your choice.
Your buddy's story makes it real. So, low fees because it's simple and automated. Kind of genius, actually. But even with cheap fees, if the whole market tanks, aren't you still losing everything?
That's a fair worry, and it's where things get real about riding those waves.
Yeah, those waves sound scary. Like, if the whole market crashes, doesn't that mean my index fund just plummets too? Feels too risky for someone like me who's just starting out.
I hear you. Nobody wants to watch their money vanish like ice cream on a hot day. But let's unpack what really happens when the market fluctuates, those ups and downs we all hear about. Your index fund moves with the market because it mirrors it. So if stocks overall dip 10% in a month, your investment dips about the same. It's not a total loss though. It's a paper loss until you sell. The key is markets don't stay down forever. They're tied to the real economy, where companies keep making products, hiring people, and growing. Think of it like ocean tides. They pull back, but the water always comes rushing in stronger eventually.
Paper loss? So it's not gone for good unless I panic and sell?
Exactly. Selling low is what locks in the hurt, like jumping off a swing at the bottom instead of riding it back up. Take the 2020 pandemic crash. Markets tanked 34% in a month as everything shut down. If you'd had money in an S&P 500 index fund, yeah, it would have dropped hard. But by the end of that year, it bounced back 16%. And over the next few years, it climbed over 50% from the low. Why? Vaccines rolled out. Businesses adapted with online sales, and the economy roared back. Your fund would have captured all that without you lifting a finger, holding steady through the storm, because it's diversified across hundreds of companies. Not all eggs in one basket means one bad egg. Like a airline grounding flights, doesn't spoil the whole bunch.
Diversification saves the day again. So even in a big drop, I'm not wiped out like if I bet everything on one stock.
Spot on. Single stocks can go to zero if a company flops, like some old tech firms in the 90s bust. But an index fund spreads your bet across the economy's winners and survivors. Historically, the S&P 500 has weathered crashes, like 1929's Great Depression drop of 86%, or 2008's housing mess at 57%, and always recovered to new highs. Over 100 years, it's averaged about 10% annual returns, turning $100 in 1926 into millions today. Fluctuations feel wild short term, like a bumpy car ride, but zoom out to decades and it's a steady climb uphill. Beginners get spooked by the dips, thinking it's gambling, but it's more like farming. You plant seeds, weather some storms, and harvest big if you stick around.
Farming analogy fits. My uncle's got a small plot and he says patience beats rushing the crops. But what if I'm in for a long dip, like years? Does the fund just sit there losing value?
Good pushback. Long dips happen, like the 1970s stagflation, where markets were flat for a decade amid oil shocks and inflation. Your fund would have chugged along flat or slightly down, but not lost everything. Companies still paid dividends, those little payouts from profits that add up. And diversification helped. While energy stocks struggled, consumer goods kept humming. The fund doesn't lose in the sense of vanishing. Values adjust with reality. If the economy is growing overall, and it has from horse carriages to smartphones, your slice grows too. My first investment teacher shared a story. She put cash into an index fund during the '73 oil crisis, ignored the gloom, and by the '80s bull run, it had tripled. No crystal ball needed, just riding the economy's engine.
Dividends? That's like extra sprinkles on the ice cream. Okay, so ups and downs are normal, and the fund smooths the scary parts with all those companies. Makes me less worried about starting small.
You're piecing it together nicely. Fluctuations test your nerves, but index funds shine because they force that long view. No knee-jerk sells. They reduce single stock risk by owning the crowd, so one flop gets diluted. And historically, that broad exposure has meant your money rises with America's innovation wave, from cars to the internet. Even in down years, the overall trend is up, building real security if you don't bail.
Yeah, I see how it recovers. But if dips aren't the end of the world, how does jumping in early make the ups even bigger for someone my age?
That's the magic part. Time is your secret weapon when you're young. Starting early with index funds supercharges your money because of this thing called compounding. It's like a snowball rolling downhill. It starts small, but as it picks up snow, it grows bigger and faster the longer it rolls. You invest now, say $100 a month from your part-time job, into an S&P 500 index fund. That money buys shares that grow with the market, about 7% a year on average after inflation. But here's the cool bit. The games earn gains too. So year one, your $1,200 turns into maybe $1,284. Next year, you add another $1,200. But now the whole pile, original plus that first growth, earns more. Over 40 years till retirement, that could balloon to over $300,000, even if you never bump up your contributions.
Snowball, yeah. But $100 a month feels tiny. Like, will that really add up, or am I just kidding myself starting so small?
Totally get the doubt. It seems pointless when you're staring at a coffee budget. But small adds up huge with time on your side. Picture my cousin. At 18, she tossed $50 a month into an index fund while in college, scraping from babysitting gigs. No big leaps, just consistent. By 30, with compounding kicking in, it hit $15,000 without her doing extra. Fast forward to now, she's 45, still adding a bit more as her salary grew, and it's over $250,000. That's house down payment money, all from starting tiny and letting the market do the heavy lifting. If she'd waited till 30 to begin, even doubling her monthly input, she'd have less than half that today. Youth gives you decades for the snowball to pack on layers. Most folks don't get that runway.
Your cousin's story is motivating, so it's not about how much I put in now, but how long it works for me?
Bingo. Consistent contributions are key, like watering a plant regularly instead of flooding it once. Dollar cost averaging, that's the term for investing fixed amounts over time, means you buy more shares when prices dip and fewer when they're high, smoothing out the bumps. And index funds make it easy. Low fees keep every penny working. No waste on expert guesses. Plus, they beat inflation, that sneaky rise in prices that eats savings accounts alive. Your grandma's old bank CD might grow 2%, but inflation at 3% means you're losing buying power. Index funds historically outpace it by 4 to 7%, so your money doesn't just sit, it multiplies, turning today's $5 latte skip into tomorrow's vacation fund.
Dollar cost averaging sounds smart. No timing the market perfectly. Okay, so starting young means more compounding time, steady ads, and staying ahead of rising costs. But isn't there a catch? Like, does it really work that well without some hidden downside?
Fair to wonder, nothing's a free lunch. The main catch is patience. You can't touch it early without missing the big growth, and yeah, markets can stutter, testing your grit during dips. But for index funds, that's minor compared to the wins. No guarantees on exact returns. Past performance isn't future-proof. But over long hauls, the economy's track record is solid, driven by tech, healthcare, all innovating forward. Taxes and such nibble if you're not in a retirement account like a Roth IRA, but starting young lets you max those tax perks too. My own first $200 in an index fund at 16, it's part of a nest egg now that bought my first car. The real downside? Not starting. Watching opportunities slip while bills rise.
Patience as the catch makes sense. I'm not great at waiting, but for money growing on its own, worth it. So all this compounding, steady investing, beating inflation, it's like a cheat code for building real wealth without being a finance whiz.
You got it. It's accessible power. Teams like you can open a custodial account or IRA with apps like Vanguard or Robinhood starting with $1 even. Imagine, by 25, if you keep at it, you're set for milestones like college or a home, all from smart, simple moves. No need to chase get-rich-quick schemes. Index funds reward the steady path. Feels empowering, right? You've nailed the whole picture now, from what they are to how they build your future. Keep that curiosity. It's your edge.